Thanks for tuning into this earnings conversation. Granules India came out with numbers yesterday, which were pretty exceptional. Revenues up 22%, net profit up 70%, and that was largely a result of margins moving up from 20.5%, as I read, to 29.8%. Question to the management is about the continuation of business momentum as he sees it, because viewers would remember, if they do, that in the last conversation that we had post the numbers of quarter one, the management had spoken about the possibilities of 30 to 35% growth for the year. What are the underlying drivers? Let's get in Mr. Prasad Johnson right now on the show to talk about all of that. Good having you, Mr. Prasad. Thanks so much for joining in. Hope all is safe.
Hi, Niraj. Okay.
Yeah.
Just
all is safe, I hope. I was
Okay.
going to ask you about the numbers and whether the underlying drivers of what happened in quarter two, which was pretty exceptional, remain the same as it was in quarter one.
It was almost the same, Niraj. Nothing much has really changed. The fact that we were actually able to keep our costs under control really helped. And we were being very cautious and providing for extra costs for manpower and other utilities and also COVID related stuff. So while COVID still, we spent a lot of money. In this quarter, we spent close to, I think, 13 crores or 19 crores in COVID alone. We were able to control it. So the expenses were under control. And also the product mix also was very favorable. We were able to make more profitable products. And some of the new launches have really picked up. And our market share on these new launches has done better than what we had expected. And basically keeping costs under control, new launches and highly profitable products picking up market share. These were the main growth drivers.
And I would presume some of those, profitable products would probably the reason for the drivers for the gross margin for the quarter as well.
Gross margin again is a function of many issues. It's a function, of course, product mix, like you said, that's one of the reasons, and also the inventory build-up. We are actually building up more inventory for our own launches in the US, and the inventory build-up also has an impact on gross margins. However, EBITDA has grown, and the profitable product mix and better market share for profitable products has resulted in a better EBITDA. So gross margin really doesn't make sense. We can always talk about EBITDA, and EBITDA is something that we will be able to maintain or a little bit plus or minus here and there going forward. Gross margins can vary a few percentages.
Okay, you just kind of stole my question. I was going to ask you if these levels are sustainable with all the factors that you foresee for the next couple of quarters, if it's possible to foresee that far.
Yes, we have very clear visibility. In fact, I can definitely confirm that we see that the same momentum will continue. We did about 80% growth in the first half compared to the first half of FY 20, and the same momentum will continue. And for FY 21, we expect to do the same percentage growth in PAT compared to FY 20.
Okay.
So directly, we expect to do around 80% increase in PAT this year.
That's commendable. I just wonder if you reckon that as you stand at the end of the first half of the current year, whether that momentum can spill over as well, because there's a distinct difference between your revenue and profitability, and the base might still continue for the next 2-3 quarters.
The base on the revenue, you mean?
The base effect, yeah, the base effect of maybe the revenue growth being 22%, but the margin impact still helping you.
Margin impact is helping us because the new products are there, and these new products will continue to be there, and we are also having more launches happening. We have about 6 products which have been approved but not launched, which will be launched in the coming 2 quarters, and also we are expecting few more approvals in Q3 or early Q1, which also will possibly be launched in Q4 or very early Q1 of next year. So we have very clear visibility in what are the products that are going to give us this margin, and we are quite excited about the opportunity. And just to be clear, the growth is over FY 20, but not a sequential.
Yeah, sure. Any thoughts on the inventory days and the payable days and the way they shaped up? There were a couple of questions around why the increase happened.
No, no, no. Payable days, of course, inventory, I said we are building up a lot of inventory. Whenever we have new launches, the inventory has to be built up. Unless we have 3 to 5 months inventory, it's not safe to launch. Because if we launch and then don't supply, we have failure to supply penalties. So that's one reason inventory has gone up. And also, whenever we ship from India, now you know that we have our own marketing front in the US. Either the inventory that's on the sea or the inventory sitting in the US is part of our inventory. If we had a partner, we would have treated it as a sale. So that's why the inventory is going up. And because revenues are going up, especially our direct sales from our marketing front, the receivables from distributors are not as quick as it would have been from a partner. So receivables have come up, and somewhere we have to balance it. We also have been negotiating better terms with our suppliers, and we have been trying to get better terms. So we are trying to balance the whole of it. If you see the net effect, cash to cash cycle has actually gone up only by 1 day from 103 days to 104 days. We have done well, but this is going to be a challenge going forward, and we are doing everything possible to make sure that it doesn't really go beyond control, and where we may have to uh, where we would like to manage with our own internal accruals, the increase in working capital. And so one of the key areas we have to focus is on cash to cash cycle and
Okay,
also payables and receivables.
sure. Um, any outlook that you can give on all the three segments? Because I'm guessing that if you're indeed looking to what 40-50% of your APIs into formulations as well, you must be frowning when people call you an API company. So can you kind of talk about APIs, FPIs, and formulations, and how do each of these segments look?
I used to tell people, look, we are not an API company, we are an integrated company, and the end product is formulations. So, like you said, most of our API, more than 45% goes into our own formulations. But today, API seems to be a very, very sexy and fancy word. So, but still, I would like to
Yeah.
correct people saying we're basically a formulation company with integration into APIs.
Yeah, but how do the segments look? I mean, APIs, PFIs, and formulations. How does the outlook? I mean, you told in numbers how it looks, but I'm just trying to get a color on the basic business.
Today, I mean, we are doing about 52% or so in formulations, and this is still growing. And going forward, we see some, I mean, the next few years, we'll be doing about 70% of formulations, and the rest will be distributed between PFIs and APIs, APIs being the least. We do sell APIs wherever they're profitable, and the only API we sell as APIs, the majority is only paracetamol, which we sell to some of the branded companies. Otherwise, not much goes into domestic market or into other markets.
But you do also have a multi API facility, if I'm not wrong, at Vizag, fully operational by next year. Again, the same modus operandi stays. A large portion gets converted into formulations, or because the demand for APIs is so strong, you could take a call depending on that.
No, it's mostly going to be into formulations, but some of those, till we get approvals in our formulations, will be some products we have already filed with API from that side in our formulations. We expect quick approvals, but other APIs are going to take a while. And till we get approvals for those APIs in our formulations, we will be selling those APIs mainly in the domestic market. But
Okay.
ultimately, it will be mostly consumed in our formulations.
Fair call. Last couple of questions, Mr. Prasad. Usually, people get very happy when managements which are doing well are announcing large capex plans because it exudes the confidence of the management of the future. You've done that very successfully in the last few years. All your expansion plans are bearing fruit now. Some quarters of the market, when people who track pharma very closely, are a bit not concerned really, but questioning the large capex still under play. I presume 800 to 1,000 crores, if I'm not wrong, or slightly more than that in play for the next 2-3 years. Do you foresee a market that strong for that time for you to incur such large capex?
Actually, in areas we have been finding it difficult to catch up with the market demand for the last few years. So this year we have been a little more aggressive. We are building ahead of time. But however, I see that also running out. So we are actually facing challenge against time. So we do not see, and most of our capexes have very quick returns. So between, and if you have seen our ROCE of 33%, of course, it may go down to 30% or 31%, but definitely with all the new capexes, some of them are short-term returns, and some of them are medium term, some of them are long term. So overall, the ROCE is the key factor that decides on our investment. And by the way, for this year and next year, we have been looking at about 400 crores of capex. And going forward, we are still drawing up plans, and definitely wherever necessary or wherever we see a good return, only we'll invest. And even though debt is always a possibility, debt is available very freely at very, very attractive cost to Granules today, when working capital and long term. We are not looking at debt to fund these capexes. It will be mostly out of internal accruals. It is a challenge funding working capital increases and capexes, but we are confident that we should be able to manage.
So am I reading this correctly? You reckon that these large capex plans that you have will immediately fructify into almost fully capacity utilized facilities, and the return ratios would be almost equal to what normalcy is within a span of couple of quarters?
Yeah, one quarter, so it may drop, but ultimately, by the end of the average out for the end of the year, I think will be around at least 30%, at least,
At
in
least
spite of the new capex going in. So that's how the whole plan is happening. So while we see a great attraction to put in more money, we are being very, very cautious, especially going by the last few years of experience. 2 years ago, when we invested 1,400 crores, so we are being a little cautious. But then the situation has totally changed. If you look at our debt EBITDA ratio 2 years ago, which was 2.5%, 2.5 times, and today it's 0.7. So the situation has totally changed, but still, we would like to be cautious for a while before we really feel more emboldened. Let's build a solid company before we do anything better, anything different.
Okay. One last question, Mr. Prasad, and that's on the interest for the space. I mean, not just you, right? Some of your peers, all of your peers actually are seemingly putting the right foot forward, and India is being touted. I mean, Bill Gates, no less, mentioned that India's manufacturing and research facilities would be great. I mean, in the tweet to Prime Minister Modi. My question to you is: would you reckon that the space at large that you are operating in, it could actually become large, could draw multiple points of interest from various sets of investors, be it private equity, be it actual firms, so on and so forth, over a period of the next 3, 4, 5 years? Because the reason why I asked this is because we were just doing some math and how the PE interest in Indian pharma in 2020 already is much higher than any of the years in the recent past.
Yes, definitely. You are perfectly right. And practically, I see a lot of interest. I keep getting approached by a lot of people, and
I'm
there's a lot
sure.
of questions coming out from the market if something is happening here on which I refuse to comment. But definitely, there's a lot of interest, and I see this interest continuing.
Yeah, I was just asking you from an industry perspective, not from a Granules
No,
perspective, because I
I,
understand you don't
I'm
talk on that,
talking about
obviously.
my experience when people approach me,
Yes.
and the same. I talk to peers, and they also tell me that a lot of people, a lot of peers are approaching them, and I really have not seen any of my peers or anybody really wanting to lose an opportunity like this. They want to continue and grow the business and keep continuing what they're doing.
Yeah, I mean, I just wanted an industry perspective, sir. Thank you so much for giving me that. And keep up the good work. All the best for the quarters ahead.
Thank you, Niraj. Thank you very much.
Pleasure was
Thank you.
ours. And viewers, thanks for tuning in to this earnings conversation with Granules India.